What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we're talking about policy design, how to properly structure whole life insurance policies, particularly for the infinite banking concept. If you want access to a lot of cash value, I'm going to show you an example of a really bad design for a whole life policy. This is a real client that I'm working with right now. I'm helping him to kind of salvage the situation a little bit. There's going to be some really, really important lessons in this video, guys. So I highly encourage you to stick to the end, because I want to share this so that you don't make the same mistakes. So that if you're interested in the infinite banking concept, dividend paying whole life insurance, you know how it needs to be structured based on your specific goals. All right. And it's also a clear example, like when I show you these things, why it is so important to work with somebody who knows what they're doing. That's number one. Okay. Knows how to custom design policies based on your specific situation and what you're trying to accomplish. Also, number two, you want to make sure you're working with somebody that's going to listen and actually understand, get to know what your goals are, right? So they know how to design it. And I think there was just maybe a lot of miscommunication when my client set this up, not on his end. Maybe, but it's usually on the agent's side where they didn't get enough information. They weren't listening. Maybe they just don't care. I don't know. I wasn't there for it during that conversation when he set it up. But when the client I'm working with saw my first policy and we had our first conversation about infinite banking and all that, he said, like, that's exactly what I wanted. Not what I have here. Like when he sent me the illustration for his current policy, it was just not even close to what he actually wanted to set up. And it's really, really unfortunate. So lots of learning lessons here. I also want to say I'm not bashing any particular company. The company that he set up the policy with was Mass Mutual. Fantastic company. You really can't go wrong with any of these mutually owned life insurance companies. They've never missed a dividend payment. They've been in business over 100 years. Mass Mutual is definitely one of the big ones. It's probably the biggest. They have fantastic products. So this is nothing against Mass Mutual or any company, but this is a perfect example of why policy design itself is so important. And you really want to take your time with these things. You don't want to rush into it. You want to run multiple different illustrations. I probably ran 15, 20 different illustrations for this guy, just figuring out the best way to design the policy for what he wanted to do. And that's what you have to do, guys. And I don't think that was done in this particular case. So I'm going to share my screen. Obviously, I'm going to have some things blurred out for privacy purposes, but these are real illustrations, real policies. The one that we're setting up that I'm going to show you, it's how you are supposed to design a policy. In his particular case, we have that pending as an application right now. But I want to show you. Let's start first with the really bad design. And also, I want to clarify too. Hang on, let me pull this up here. When I say bad design, when I look at this policy, I think this is a bad design because it's not something I would ever set up for myself. However, if this is what my client actually wanted, it wouldn't be a bad design because it's what he wanted. It's like based on his goals, situation, what he was trying to accomplish. If this is what was going to be best for him, then that's not a bad design. So keep that in mind. But when he saw the illustration I ran for him, based on how I'd set my policy up, how he wanted it, he's like, he was really, really angry. He was not happy with the agent that set this up at all, because for a number of different reasons. But let's break it down. So essentially what we have here is a 100% base policy for somebody that wanted access to a lot of cash value to potentially implement the infinite banking concept. He wanted access to his cash value. He wanted as much cash value as he could get in the first year, and he didn't get it. He's paying he's on the hook for a little over $52,000 per year. Now, I'm going to break this number down here in a minute. But look at by the end of the first year, what his cash value is. It's only $13,325. That's not good for somebody that wants access to cash value. I'm not even really sure how we came up with these numbers, like they're 52,000 and whatnot. Because when I spoke with my client, with this gentleman, he wants to dump a large amount of money into the policy in the first year, so he has access to a lot of cash value, but then he did not want to be on the hook for a ton of money moving forward. It's exactly how I set my policy up. I did 120,000 in the first year, had access to like 88% of my cash value. It's exactly what I wanted, but then I'm only putting in $25,000 per year after, and I'm not even on the hook for $25,000 per year. So if income fluctuates, and I can't put $25,000 per year in afterwards, I don't have to. I have that flexibility. In this policy, he does not have that flexibility. He is on the hook for $52,000 per year. Now, this gentleman makes a really good amount of income. So I told him, look, even though this is not an ideal situation, if you can make the payments in the long run, this is going to be really good for you. Okay. But it's being on the hook for $52,000 per year. It's not having access to the cash value the way he wanted to. That is the things that he has the biggest issue with, and I don't blame him. So from an efficiency standpoint, and a cash value standpoint, it was definitely not what he wanted at all. The break-even point isn't until year 14. It takes 14 years for him to finally break even. That's a long time. In the policy that we're setting up for him with Lafayette, he's going to break even between year 4 and 5. And he's going to have access to this 88, 90% of his cash value within the first year. Heck, within the first 30 days. Because he has an investment opportunity that he wants to take advantage of, but he wants to put the money in the policy first because he understands the power of the infinite banking concept. Unfortunately, he didn't really know the mechanics of the policy and also the design aspect of it, right? So, not a very good setup for his specific situation. Now, like I said, in the long run, he's going to be fine. He's going to, he still has access to cash value as he continues to pay in. It's not ideal, all right, but it's going to work out in the long run. That's a beautiful thing about whole life policies is even if they are designed poorly, they'll catch, like with time, they will improve and they can, they'll still provide a lot of value to you. But if it's not what you wanted, then, and now you're on the hook for this, well, that's a whole different story. Now, fortunately, he only pays into it for 15 years. So he did a 15 pay. I think that's why he was able to get some cash value, because normally with 100% based policies, you don't get access to any cash value. But with this particular one, he did have access to some. And I want to show you, again, just some things to look at when you're going through these illustrations. All right. So if we scroll down here, you can see that there is no paid up additions rider at all right here. There's nothing. So that's how we know it's 100% base policy. He's on the hook for $4,115 per month plus the $241 here per month because he was rated. So $4,300, he's on the hook for the 15 years. Now, over time, as he gets access to more cash value, the dividends grow. It can, like, basically what I told him is you can use, instead of the dividends, buying paid up additions, which is what he has set up right here. So the dividend goes to paid up additions. That's what gets the compound growth. The death benefit grows, cash value grows, etc. But he could eventually use that dividend to pay a portion of the premium if he wanted. And, he can always take policy loan to make the premium payment if he wants. I told him that's kind of like the worst case scenario. You don't really want to do that. So I explained it to him, and because he was initially going to cancel the policy and surrender it, and he's going to take a $30,000 hit. I told him, look, if you don't have to do that, if you can make the payment, the $52,000 each year, I know it's not ideal, but if you can do it, this will pay off in the long run. You'll be okay, and you don't have to eat that $30,000 hit. And so for now, he's deciding to keep it because he can make that payment. He just doesn't really want to. Plus, he's setting up more policies right now. So, but anyways, this is how we can tell. It's a 100% base policy. The other thing I want to point your attention to, guys, is the difference between paying monthly and annually. And he did not know this. Like he didn't know about these additional costs and the 100% base policy and whatnot. Like he didn't understand these things. That's why it's really important to learn how these things work. You don't have to be an expert, but just know what to look for. So another thing that I pointed out is you're paying an extra $2,200 per year in charges just by paying monthly. That's a lot. That's a lot of money. By simply switching to an annual payment, there's no charges. Now, if you're okay with this, like if monthly is better for you and you're okay paying these charges, fine, but know about it. Like he didn't know that. So he could actually save $2,200 per year if he just paid his premium payment made his premium payment annually. So just some things to look at, guys. Again, this is nothing against MassMutual. I love MassMutual, great products. And like I said, I'm going to be looking to get contracted with them very soon. I'm trying to get contracted with tons of companies, but so nothing against them. It just comes down to the policy design. All right. Now, with that said, so again, just to recap this, let's go. What page was it? 3? Yeah. So just to recap, guys, very low cash value in the first year. He doesn't break even till years 14. The policy doesn't start growing by more than what he's putting in until year 7 right here. So you see the net increase in cash value, 53,000. He puts 52,000 in. So now it's starting to become a lot more efficient. In the policy that we're setting up for him, I believe it's year 2 or 3 that his policy grows by more than what he puts in. His break even is between years 4 and 5, and he has access to a ton of cash value in the very first year. So I want to show you that policy here. All right, so let's go to the tabular detail. And actually, you know what? Let me do this breakdown first. So you saw the 100% base policy, the fee for rating. There was no paid up additions rider added to it. So what you want to look for here, you can see we've got a level premium PUA rider that's paid up additions. This is what you want if you're trying to structure your policy for high cash value. Okay, I think let's see. So he's 50 years old. And I just ran it as a standard rating for now. So we had to bump the base up a little bit more than I normally would, but it's still really efficient over the long run because he's doing that large amount, that large dump in the first year. And I'll show you that in a second. But you can see here, this is what he would actually be on the hook for the first 10 years. So we're doing this is actually a 10 pay with Lafayette. What's really cool about Lafayette's PUA rider, though, is after the 10 years and the base premium is gone, you can actually still put in paid up additions. A lot of products, a lot of companies don't let you do that. It's actually a really neat feature of the paid up additions rider with Lafayette. It's really, really cool. So he's actually able to fund the policy for 15 years. But this is what he's on the hook for the first 10 years. So it's a $10,000 base premium. His term policy is quite a bit higher just because he's a little bit older. That's why also, too, guys, I stress like doing this as early on as when you're young if you can. But that doesn't mean it can't work. All right. And you'll see that in a second. So this is the 10-year term rider. And basically what this does is it avoids MECing the policy, modified endowment contract, where we lose all the tax benefits. We definitely don't want to do that. Tax benefits are really powerful. So we did a 10-year policy here. I did 10 years too to give him a little bit of flexibility if he wanted to, if he wants to convert this 10-year policy, 10-year term policy into another whole life policy later on down the road, without risk of MECing the policy, like if you have to do it in year 7. So plus he wanted the death benefit for a little bit longer as well. He has family, young daughter, so death benefit is important to him. All right, and then the $120 here is just the minimum that you have to put into the paid up additions rider in order to keep it active on the policy. All right, but he has the discretion, the ability to put in an additional $11,600 per year if he wants. So he could do a total of roughly about $25,000 per year if he wants, which I did strongly recommend him to do. The level of income that he has, it's it would be very easy for him to do that. But what he really liked is that should his income fluctuate, he's not on the hook for $50,000 in order to keep his policy in force. He's on the hook for $13,453 per year, not to mention the efficiency of the policy too. Let's actually go to the tabular detail here now. All right, let me blow this up a bit for you guys. Sorry, I didn't realize how small the text was there. But you can see here, let's see, 150,000 for the first year. That's the dump in that he wants to do. He's going to get access to about $136,000 year one. All right. And he'll have access to roughly 95% of that number within the first 30 days. All right. So, but you can see afterwards, he can put in $25,000 per year if he wants. He doesn't have to. All right. The policy grows by more than he puts in every single year. It's why you want to max fund these things when you can. You want to put in as much paid up addition as you can, because this is what happens when you put $1 in and you have access to $1.10, and then the next year you put $1 in, you have access to $1.20, and it just keeps growing and growing and growing. Why on earth would you not want to put as much money into that machine as you possibly can? It's really, really efficient. And so it's growing by more than he puts in the year two. Let's see, was it year 4? So he's put in 225. His net cash value is 220. So between years 4 and 5 is break even. All right, he's more than break even, a little bit more than break even by year 5. We'll just call it year 5. Okay, that's really good. That's a pretty solid design, and his net internal rate of return over the course of time is, because I ran this here too, it's roughly 3.6%. Over it gets more and more efficient over time. And I can already see the ridiculous comments from IUL advocates. It's a terrible rate of return, or Dave Ramsey followers. Terrible rate of return. And I've done plenty of training on why internal rate of return is just a bonus. We don't set these things up for internal rate of return. But if you were to ask me, like, if I'd be interested in a savings vehicle that would get 3.6% tax-free compound growth for life, and it would provide a massive death benefit to my loved ones if something happens to me prematurely, I'd be able to access a large portion of that death benefit if I got diagnosed with a chronic, critical, or terminal illness. I'd say that's a pretty good savings vehicle. So, we're not comparing this to investments, but he's also going to use this policy as cash value to make investments. He already has stuff lined up that is going to do really, really well. So now he's making money twice because he's got his policy. It's going to get a really good, a safe internal rate of return. And then he's making his investments over here. The only cost of doing that is the amortized simple interest. As just a no-brainer. But for me, this is a really, really good savings vehicle right here, guys. I just don't know how you beat it. But anyways, going back to the illustration, just to reiterate, I mean, this is how we design policies. First we want to understand what it is that you're trying to accomplish. What are the problems you are trying to solve that are most important to you? All right. Understand how these things work, and then custom engineer the policy for that specific situation. So after year 10, that's when the term policy falls off. That's why you see a big drop in the death benefit, but it's just going to continue to grow there. He's got another 5 years you can put in the paid up additions. We could do this longer, but he wanted to pay in for 15 years. So that's how we set it up. And this is almost pure cash value going right into the cash value. Paid up additions, 95% shows up in cash value immediately. And you can just see the increase in net cash value just going to continue to grow and grow and grow. It cuts off a little bit, obviously, once he stops making the payments, but it's going to continue to grow for the rest of his life. And by the time he's, if we look at numbers here again, also this is just an illustration, guys. I like to be clear about that. The dividends are not guaranteed. However, Lafayette has never missed a dividend payment in 119 years. Really, really solid. Financially sound life insurance company. I'm going to bet that they're going to continue. Not to mention that dividend rates are pretty low right now, so he's setting this up at a really good time. But it's just going to continue to grow by the time he's 80. Let's see. Our cash value. All right. I mean, a little over almost $1.1 million. Got a really good death benefit too, in addition to his other policies. So, he's going to be pretty good. So anyways, I think I'll go ahead and wrap up there, guys. I completely screwed up my intro, didn't I? Sorry about that, guys. There we go. My millennial stuff. Anyways, I hope that was helpful, just to give you an idea about how policy design works, seeing the difference between a properly structured policy and a really poorly structured policy, like just the difference between good design and bad design. And again, just remember that it comes, whether it's good or bad, it comes down to what you want, what you are trying to accomplish, right? There's no like magic way to design or like cookie cutter way to design every single policy. It comes down to what are you trying to accomplish and what do we need to do to get the best policy that we can. All right, adding term riders, paid up additions, and different base versus PUA ratios and stuff like that. Like you want to make sure you're custom designing it specifically for you. So I hope that helped, guys. If you have any questions, please drop them down in the comment section below. If you already have a policy and you'd like us to audit it and review it, make sure it's exactly or at least close to what you thought it was going to be and what you wanted. I'll have links down below. You can book a call, or if you don't have a policy and you're interested and you want to have a conversation, see if it's right for you, happy to have that discussion with you. All right. So hope you guys are crushing it. I will talk to you in the next one. To your success. Matty Ice is out.